fellow traders, welcome back to Store Capital. I hope you're all having a great day. Today we'll be going over the ICT silver bullet strategy, which has been going crazy on social media right now due to its high win rate and accuracy. So I'll be showing you guys how you can use it in a very optimal way. So first, let's go over the rules. The rules is we only take our positions between 10 a.m. and 11 a.m. So our trades only between 10 and 11. Number 2 is a sweep of liquidity between 9:50 and 11 a.m. So we take our positions from 10 a.m. but 10 minutes before that we can start looking for sweeps of liquidity due to the New York macro, which is 9:50 to 10:10. The third rule is we want the displacement in the opposite direction. So if the liquidity sweep is downwards, we want a displacement going upwards. And if the liquidity sweep is upwards, we want a displacement going downwards. Number 4 is a fair value gap in that displacement. And number 5 is a 10 handle range between the fair value gap and the next external liquidity. Number 6 is we enter, if number 5 is true, we will enter on the pullback to the fair value gap with a 5 handle stop loss and a 5 handle take profit. So let's go to the chart and look at a few examples. Use only the 1 minute time frame. So here I have Monday's data. Monday 15th, last week we were gonna review last week's data. So if we look at Monday, my session of 10 a.m. to 11 is marked out in purple and my 9:50 is marked out in blue. So 9:50 would have started here. So as you can see, we had a move down, then a move up, then a push down. And if you look at this push down, it takes out this liquidity. So this is our sweep of liquidity right there. So what we are gonna then be looking for is a displacement in the opposite direction. So remember, as I said, if we have a push down, if we have a sweep going down, we want the displacement going up. So this would have been our displacement going up here. And now, since we have the displacement, we look for fair value gaps in that displacement. So this is where you need to pay attention, as we have a fair value gap here. Price didn't pull back to it. Price created a new fair value gap. So as soon as there's a new fair value gap, the old fair value gap is no longer valid. So we focus on the latest fair value gap. So with this fair value gap, what we would have looked for is if we have a 10 handle range between that and the next external liquidity. And the next external liquidity was up here at the top at 5155. And our fair value gap is at 5129. So that's about 1050. That's about a 25 handle range. So we have more than enough of a range. So when price pulled back, you see it pulled back with one candle. That would have been our entry right here. Stop loss 5 handles. Since our entry is 4129, our stop loss is going to be 4124. So we minus 5. So 4124.25. Take profit, same thing, we're going to add 5. So 29 plus 5 gives us 34. So this would have been our take profit, if I'm correct. Yes. And as we can see, in this scenario, we hit TP. My position size was downwards, but yes, let me just put that on again. This would have been our entry. This would have been our exit. And in this scenario, we hit TP. Let's go over to Tuesday so we can see if we won. Okay, so now we are Tuesday. This is Tuesday's data. So now let's apply the same rules and see what the market does. So this is 9:50. The market drops. When the market... Oh, okay, 9:50 is here. 9:50 starts here. So we have this consolidation, then this move up. Then as soon as we have this push here, we've taken out the liquidity. So liquidity was swept here. we're gonna mark out our liquidity. Now we look for displacement in the opposite direction, which is this move over here. That's our displacement. Now that we have the displacement, we mark out our fair value gaps. So the first one was here. Price didn't pull back to it. The second one was here. So as you can see, with the second fair value gap, price pulled back to it. So what we would have done is to check if we have a 10 handle range from the fair value gap to the next external liquidity. So this is the next external liquidity here, which is 4148. The fair value gap is at 4132. So it's way more than 10 handles. So we would have entered our position here. Stop loss 5 pips behind that. Since our entry is 4132, our stop loss is going to be 4127.50 if I'm correct. That's 5 handles. Yes. And our take profit, we add 5 handles as well. So our take profit is going to be 4137 since our entry is 4132. So on this day, we would have won also on Tuesday. One thing I want to highlight is that if you look at the candle before, you can see that we had a fair value gap on the down leg, which still extended to the current leg. So that's what we call a balanced price range. So when you have a balanced price range, your position has a higher probability of working out. The same thing happened on Monday. I just didn't highlight it, but it's one thing to keep in mind. Look for balanced price range. Let's go over to Wednesday. Okay, so this is Wednesday. If you look here, this is 950. 950 comes down here. We have this slight consolidation here. This is a little bit of a move up, then a move down. So that is our liquidity sweep right here. We took out this liquidity here. So now what we look for is a displacement in the opposite direction. Displacement here. This was our displacement. Now in the displacement, we mark out our fair value gaps. No fair value gap here, but we have one here. So we mark it out. And price did come back to this fair value gap, so that's where we would have taken our entry. So we check to see if we have a 10 handle range. So our fair value gap is at 4132. The next external liquidity is at 4144. So that's 11 handles. It's more than enough of a range. So you remember, as I was speaking about on the previous examples, that we need a balanced price range. It's not a must, it's just an extra confluence. And if you can look at the previous down candle, it was a fair value gap, which was the last down close candle, which had a balanced price range, which extended to the current price, since price didn't trade through it. So that is an extra confluence, seeing that there's two fair value gaps. So then what we do now is that's where we take our entry with a 5 handle stop loss and a 5 handle take profit. So I'm putting on my entry there. My stop loss 5 handles below. As always, we minus 5 and we add 5, as we only target 1 to 1. So on this particular day, this would have been the setup we took, and on this day we would have won. So you can see how simple it is. Let's go over to Thursday. So this is Thursday's data. So far we have 3 winners. So if you notice, our 950 is in red. That's because we took out liquidity going to the other direction. So as you can see, we have a small consolidation, then we have a push up, which takes out liquidity, which I've already marked with a line. So now we look for a displacement, since we've taken out liquidity. So as you can see, we have a small little displacement going down over there. So now that we have that displacement, even though that's not the biggest displacement compared to the other ones that we would preferably want, it's still a valid one. So we mark out our fair value gap over there. And if you notice what that fair value gap is, that we also have a balanced price range. As you can see, the balanced price range is a common theme, with the last up close candle having a fair value gap. So we mark that out. Then we check to see if we have a 10 handle range going down. And in this scenario, from our fair value gap to the external liquidity is much more than a 10 handle range. So this would have been a valid example. So we take our entry over there, 5 handle stop loss, 5 handle take profit. So we add 5 to the current price for our stop loss, and we subtract 5 to the current price for our take profit. So in this particular scenario, we would have had a losing trade on this day. So this would have been our first loss and one loss. So let's go over to Friday, the last day of the week, to see what would have happened. This is Friday, the last day of the week. So as you can see now, we had 950 open, and when it opened, it pushed up. When it pushed up, it took out liquidity on the left. So we mark out that liquidity over there. Next thing, we look for the displacement, and as you can see, we have a displacement going down over there. So after that, now we look for our fair value gaps. We have one fair value gap over there, so we highlight that fair value gap. Then after that, we proceed to check for a 10 handle range between the fair value gap and the next external liquidity. And as you can see in this particular example, we did not have a 10 handle range, as the next external liquidity is right there. There's nothing else for price to target below this swing low on the left. So on this day, we do not take the position as there's not enough of a range to target. So which means we close the week off with 3 winners and 1 loss. So out of 4 positions, this was just to show how the strategy works. You can go and backtest it yourself and optimize it in ways which you think will work best for you. So this sums it up for the video. Thanks for watching. Please don't forget to like, subscribe, turn on the bell notification, as I'll be dropping another video next week on the judo swing. So thanks for watching and peace out.